Hey everyone! Today we're answering the question, how do U.S. state corporate income taxes work? And why do they vary so much? Let's start with the basics. In the U.S., corporations are taxed at both the federal and state levels. The federal corporate tax rate is the same across the country, but each state sets its own corporate income tax rules and rates. That's where the variation comes in. Some states, like South Dakota and Wyoming, don't have a corporate income tax at all. Others, like New Jersey and Minnesota, have relatively high rates. Most states fall somewhere in between, with rates ranging from around 3% to 11%. But it's not just about the rate. States also define income differently. For example, how a company calculates what portion of its income is taxed in each state, called apportionment, can vary widely. Most states use a formula based on things like the company's sales, property, and payroll in the state, but the exact formula differs. Then there are tax credits and deductions. Some states offer generous incentives for things like job creation, research and development, or investment in certain industries. Others don't. This affects a company's final tax bill just as much as the base rate does. Why the differences? Well, each state makes its own tax policy based on its economy, politics, and budget needs. States with no income tax often rely more heavily on sales taxes or resource-based revenues. Others use corporate taxes to fund education, infrastructure, and public services. The bottom line, corporate income tax rules vary because states have different priorities and different ways of balancing their budgets. So if you're running a business across multiple states, keeping track of these differences is essential. Thanks for watching. For a free invoicing app, trusted by over 3 million small businesses, download Invoice24 from either the Apple App Store or Google Play Store. See links in description.